All right, I'm just gonna give everyone a few moments here as I see all the attendees coming in. All right, well, hello everyone, and welcome to How to Price a Loan panel hosted by the Canadian Lenders Association. We have a wonderful group of panelists today and a really interesting discussion moderated by Paul Tsai, the VP of Solutions at TransUnion. Paul's going to take us through a panel discussion, and then we will be accepting questions live. So as a reminder, feel free to submit questions at any time throughout the discussion, and hopefully we'll be able to get to them at the end. And as always, this panel is being recorded and will be emailed out to all of you afterwards. I want to thank everyone for tuning in today, but also want to give a huge thank you to our sponsor of this panel, Nomis Solutions. Nomis is kindly offering a signed copy of the acclaimed Pricing Credit Products book, authored by data scientist expert and Nomis co-founder Robert Phillips. So if you would like a copy, to request your copy, just contact info@nomissolutions.com. But without any further ado, I will pass the mic over to you, Paul, to get the panel started. Thank you so much.
Great, thanks so much, Danielle, and welcome everybody to today's session on how to price a loan. I'm Paul Tsai, as Danielle mentioned. I've been at TransUnion for 4 years, but prior to that, had quite a few roles in banking, both from a credit card and personal lending perspective. But loans and pricing loans is obviously critical to being able to grow a book and grow it profitably. And today, I think we're very lucky and fortunate to have 4 experts here who represent not just kind of the analytics side, but also the product and pricing side, both for credit unions as well as big banks, to be able to give us their unique perspective on pricing as an approach, the things that are happening in pricing today, and some of the future trends that are coming down the pipe from a pricing perspective. So with that, maybe I'll just go down the line and ask our esteemed panelists to introduce themselves. And why don't we start with Prashant, given Nomis's involvement and the sponsorship of this event. I'll have Prashant start us off and then go down the line.
Thanks, Paul. Thanks, Paul, and thank you, CLA. Prashant Balapur, I lead strategy and partnerships at Nomis. My career has been at the intersection of interesting and challenging sort of business problems, but solved through data and analytics, and nothing better than pricing. It's a topic that is near and dear to me personally and to Nomis. So for those of you who don't know Nomis, we provide what is arguably the leading platform for pricing and profitability management across all asset classes. And we've had the privilege of working with the major sort of Canadian institutions here, some who are on the panel. So great to see you all. So looking forward to this.
Great, thanks, Prashant. And Sadaqa, why don't I pass it off to you?
Thank you so much, Paul. I appreciate it. So I'm Sadaqa, the CEO of Vector ML Analytics Platform. We have founded the company about 2 years ago, and we have 2 clients so far. Me as an investment banker, or being in the fixed income, I have over 10 years of experience working for Canadian lending institutions in Toronto and Calgary and so forth. I spent the last 3 years working in London, England. I've consulted for a bunch of British lending institutions, all the way from asset classes spanning across mortgages to consumer products. For those who are new to Vector, so the whole entire genesis of Vector is really to help particularly small to mid-sized, non-regulated, non-bank Canadian institutions, and to pretty much offer a solution that helps them model their balance sheet and take decisions to optimize the return on investments from that particular things. And we pretty much help CFOs, treasurers, and financial modelers from that perspective.
Great, thanks a lot. Sundar, out west, over to you.
Thank you. I'm Sundar. I head the product and pricing for First West Credit Union. We are a BC-based credit union with 4 regional brands. We have plans to expand nationally across Canada. We're in the journey to become a federally regulated credit union. Thanks.
Perfect. And last but not least, Jeff from BMO.
Thanks, Paul, and thanks, CLA. So I lead the personal lending team for Bank of Montreal. Prior to this, I used to lead the automated adjudication for all retail products in Canada except for mortgages. And prior to that, I actually started BMO's first ever machine learning and robotics center of excellence at the enterprise level. And so I have to say all three of those things make me very keenly interested in pricing.
That's great. So again, what I love, and I think this is representative of the makeup of the CLA, right? You have such diverse perspectives and people who are expert in a particular field, but coming from slightly different perspectives and approaches, talking about a topic. So I think this is great. Let's start off for just foundationally and level setting for the folks on the panel, or on the attendees. Maybe let's go through, and if a couple of you guys can share maybe your approach or how you look at the pricing discipline, right? So foundationally, philosophically, what's your approach, or what do you think are the key components to building a successful pricing strategy? Maybe I'll ask Sundar to start us off with, kind of maybe from your perspective, what does a successful pricing strategy look like, or how do you build one?
So Paul, I will take an approach from credit union and smaller financial institutions or mid-sized financial institutions which offer, which are a full-service financial institution across line of businesses, right? So my past experience was with ATB, then I was with Schedule II Bank, First West Credit Union. So pretty much for us, it's very important that we understand our profit model, like what are we playing against? What is our value proposition compared to the other banks, bigger banks? There is only so much muscle power or funding power we got when it comes to compete in the market in the communities we serve. So it's very important to define the value proposition. What is our profit model? Understand our specific competitors. Can't have a broad stroke. We have to be very specific on that. And how does our members or customers, in your view, like they perceive the value which we offer, and we price accordingly to that. So it's we never take, on a credit union side, we never take a line of business view, even though at a product level, you set the base price. And of course, the base price is based on your FTP. FTP based is based on your marginal cost of funding. But how do you overlay on top of that? How do you add value from that base pricing? So I asked the following questions to myself. I say, are we pricing for profit or market growth? That's my first question, because capital is a finite resource compared to, like I used to be in a second largest bank in India. The same story. The capital is always finite, but the avenues to raise capital as a bigger organization is much more plausible compared to a credit union kind of environment. So it's very important. Am I pricing for profit? Am I pricing for a market growth? It can be by product where I want to grow, or it could be overall at a portfolio level. So on a retail loan perspective, it's always this question. Am I pricing for profit? Am I pricing for market growth? And then the second question is my FTP and ALM is in sync, right? Like if I meet my FTP spread, there is a fund transfer pricing margin. Am I meeting my net interest margin goals? Because that's very important. When capital is finite, I need to optimize my return, especially in an environment where I'm not the major player. So it's very important how we pick and choose our target segments. Some specific level, we always look at return at a facility level. That is, if it is a be it commercial business or retail, you see it at a example. Let's take a mortgage. You look at the mortgage spreads, and then you look at the customer relationship value of that particular. If we bring in a type of segment, what kind of profitability we have on the long run, and so you discount based on that. So if you bring a wealth relationship, deposit relationship, primary checking account, these things have discounts. Then we look at a portfolio line of business level at overall. So we start with a facility. It can be top down, bottom up, doesn't matter. But it has to make sense at a facility and customer relationship level on a day-to-day basis, at a portfolio level on a long-term basis. As far as retail loans are concerned, it's usually FTP income plus any other income that derives from the customer. As far as commercial is concerned, strictly based on return on capital, regulatory capital for us. That's very important.
Got it. So maybe I'll ask Jeff, because Sundar said this is for smaller players, but it feels like Sundar, you're taking a pretty complex and actually holistic approach to that. Maybe I'll ask Jeff first. You know, do you find that there's, you know, that's essentially, even from a big bank perspective where capital might not be as constrained, it's essentially the same approach, or would you tweak that or add to it in any way? And then maybe after Jeff, I'll ask Prashant and Sadaqa to talk about, you know, is there anything that they've seen industry-wise where, you know, there are opportunities to maybe think about things differently? But let's start with Jeff around, do big banks pretty much operate the same, or is there something that you'd add or tweak to that position?
Yeah, I think that scales pretty well, right? From understanding the core profitability, understanding of the product, how do you ladder up the price and manage your margins, both at an individual transaction and at a portfolio level. So I think all of that holds. I'll take a bit of a different tack though than at the question, and say, you know, I actually find personal lending is a very interesting space as far as pricing is concerned, because if you think about any other product in retail banking, you know, mortgages, you're not pricing losses. It's not really risk-based, right? Credit cards doesn't really vary very much, right? Fully transparent, typically high kind of pricing. Automotive lending, pricing is largely driven by the dealers. So really, personal lending is the only spot where you get that kind of intersection of, you know, risk-based price in a very not transparent market. And so I think that makes it really unique. And I will say that there's so much room to do more, right? And both at BMO and many other big banks that talk to colleagues around, you know, we follow fairly basic grids. And so where I'd like to see pricing start to go is more around, is less just straight kind of risk-based and that's it, and start looking at things more like optimizing profit based on price sensitivity. Right, starting to look at the life cycle end to end in a more holistic way, right, from origination through account management, and also I think taking a deeper look at fees. Like right now, and I'm not so sure about other banks, but I can say at BMO, like fee revenue and personal lending is not a big driver, and I think that there's some opportunities to do more there. So everything Sundar said, but plus I think there's room to evolve.
Right, and so. I think, Jeff, you said two very important words, I think, as part of your answer, which is price optimization. And I think that is such a natural, I don't know if Prashant paid you to say that, but that seems to be a very natural segue to Prashant and Nomis. So Prashant, maybe, you know, anything here that you've heard so far kind of resonates with you around Nomis and price optimization and kind of the kind of work that you guys do and opportunities you unfold for customers?
Yeah, absolutely. And I think both Sundar and Jeff touched on sort of the core elements, right? Traditionally, certainly on the lending credit side, you know, you looked at sort of ability to pay if you had risk-based pricing, right? On the personal lending side, as an example. I think the key distinction that sort of Nomis has brought in the thinking and kind of operationalizing it is to also look at kind of willingness to pay and sort of the consumer preference and the competitive dynamics of the market. And I think that is key. Pricing ultimately is a value exchange, right? It's between your institution and the consumer. The consumer and the borrower has options, right? Similarly, right, you are selecting from a set of borrowers. So how do you sort of find that right balance in that value exchange? And I think you have to look at not just the profitability and the economics of the deal, but also sort of the demand and the willingness to pay and the elasticity aspects of it. And we believe that is critical. So I think that is one. The other sort of point, which I think Sundar, you highlighted, was it's funny. I think the webinar is titled sort of pricing alone. You might as well expand it to pricing the relationship, right? And I think there is an interesting dynamic there, especially if you're not a monoline sort of lender. How do you look at the relationship holistically? But maybe, Jeff, a point that you made, and we've seen this with work done in personal lending in other markets, where you have to look beyond just the first cycle and the first term of the consumer's journey, right? They will likely come back and borrow more. So how do you evaluate kind of the whole sort of lifetime value? So I think that is critical. Maybe the one additional piece that I'll add is so much of banking and lending still has a human element to it, as in there are advisors, there are your bankers and advisors on the front line who are engaging in a dialogue. A lot of it is digital, but there are lots of aspects of banking that still have that human advisor element to it. So understanding their preferences, right? One of the things that we talk about at Nomis is your frontline is often more price sensitive than your borrowers. And how do you construct and equip them to have the right dialogue? So that's maybe the one additional piece that I would add, but great points from Jeff and Sundar.
Interesting, and maybe we'll close this section off with Sadaqa. Anything that that you want to add around leveling up, or maybe some other interesting way to look at foundational pricing?
Yeah, for sure. So if we go back to the fundamentals, pricing alone is really not that different from pricing any commodities in the world. I mean, let's just take, you walk into Tim Hortons at 8 in the morning and you get your coffee and you pay $2 for that, right? So why $2? Why not $3? Why not $1.50? Why not 50 cents? The answer is there are certain components and cost structures that goes into it, all the way from the price of coffee to sugar, milk component, servicing, electricity, overhead, cleaning, and that kind of stuff, right? In similar term, that's how we do it in financial institutions. Yes, we bankers like to make things over complex and use fancy terms like FTP and ALM and that kind of stuff, and liquidity reserve. But it really goes back to the fundamentals, what's the cash coming into the door? What's the cash going out of the door, right? And a lot of lending institutions have actually failed to recognize that there are further costs that needs to be considered, rather in addition to the cost of capital, of raising money. So it's not only about raising deposits at X% and transferring that to the cost. There's also overhead allocation, there's servicing. We're talking about prepayment assumptions. We're talking about customer acquisition costs. We're talking about what is the management desired return on investment? What's the leverage of the balance sheet? And so there are about 11 to 14 components that they will have to be considered. And if you get one of those components left or right, you actually will be shooting off right to left. Credit risk is one of those 14 components, and that's where we're getting into customer segmentation. That's the difference between getting into a different product versus a different customer. See, product have different behaviors in nature. There could be different duration, different cash flows assumption, different fees. So a mortgage is different than a credit card, but customers also, on the other hand, have different credit exposures, or some of them have a higher credit score, some of them have a lower. So really, to conclude, is basically, let's come back to the fundamentals, and let's not forget there are 14 elements that need to be considered into pricing. And that's my message to the audience. Be careful, consider all 14 elements, and wrap that around the product and the customer. And with that, you'll have a 360-degree view, and you will never go wrong with pricing. Of course, then it becomes a challenge of getting accurate data and wrapping up assumptions. But that's pretty much what we do at Vector, and that's what we have rolled out for our clients, and that's what we do as a value proposition.
Great, thanks so much. It's interesting. I say bankers tend to overcomplicate things. It reminds me of when the folks in marketing used to always get at me for using efficient frontier too much. The term efficient frontier too much, and but they were in marketing, so they knew neither efficiency nor frontiering. So, but let's move on to what's happening in the industry today. So we kind of, I think, fundamentally talked about foundationally, philosophically, what makes a good pricing strategy. But obviously, the environment's always changing, right? And as we look at the PCL environment, as we look at inflation and potential rate increases and the impact of those things, both to your book and to the consumer, I guess maybe I'll ask, maybe I'll start off with Jeff, right? What do you think, from a BMO perspective, what do we, what's kind of the read on that? And are those macro factors starting to play into the way that you price things? Like, what's the reaction, or kind of what's the mitigation there from a pricing perspective from BMO?
Yeah, well, I wasn't actually tagged on that question, but I have an answer for it regardless. So I think a couple of things. So one, I think people are talking about kind of lowest ever, loss expectations currently in the market. I guess my thought around that is that you have to price long term, right? So you can't consider the price just because losses are low today doesn't mean that they're not going to normalize in the future. And so I think, so one thing from the economic environment is, you have to make sure you maintain kind of a longer term view and not kind of fall trapped into, low loan losses today. Another element is, it's interesting the way that the pricing works, because especially with variable rate loans, we don't actually increase BMO prime, but at the same time, as our cost of funds is increasing. And so I think one thing that we need to be a bit thoughtful of as we kind of go through this escalating interest rate environment over the next couple of years is, how do we find the right balance between trying to get ahead of those of the market expectation of risk of price increases without prime actually having moved, and can we actually start to build some of that into our origination pricing today before prime moves? And then, of course, on an installment basis, it's a whole other story around making sure that you're properly hedged. But I won't go there. That's what I have off the top of my head, as I wasn't expecting that one.
Thanks a lot, Jeff. And that's the perils of me peeking out to my cheat sheet and your name being tagged for the next section. So I apologize for that, but that's a great answer, I think. And Sundar, maybe I'll look to you to see if there's anything you might add to that one.
Definitely. I just came out of an 2 hours ALCO, and the second question was in the top of the mind. I have to agree with Jeff. PCL environment made us cautious in some segments. I'll answer the first one, but then it became cautiously optimistic, and then things improve. I completely agree. You have to price through a business cycle or a product life cycle. It cannot be, I'll say, more of a business cycle. It can't be done at a point in time, right? It's it's not sustainable, and it's not reputationally, it is not great for smaller credit unions. You need to demonstrate. We are the 5th largest credit union in Canada. Still, we are very small compared to the bigger banks. So we have our niche. We have to be consistent. So yeah, those things we were cautious. We took the precautions, but it was more than a pricing play. But the second question is very important, interesting, and especially in today's what's happening in Europe. And then we have our inflation, and we have rate increase over the horizon. That's a big debate for sure. As a credit union, we focus on total relationship from deposits and loans perspective. I'm just talking about on-balance sheet stuff, right? So for us, what we are seeing is there's a threat to our main funding source. There could be a threat for our main funding source. 2 years we've been very comfortable as a banking, like a financial institution. I'm not talking only me. We are with surplus liquidity, right? Liquidity was never a constraint, right? And that also low cost liquidity. Pretty much everything was sitting in demand. The main reason, if you see one of the recent Bank of Canada's MPR, you will see that the savings rate was tremendous. Everybody knows, all conferences we talk about it. Household savings rate were high. Household consumption rate was like record low. So obviously those things were sitting in demand. So, and then there's money is going to move either out or getting consumed, or it's going to switch to a term deposit, which is going to be higher priced. So there is going to be some pressure on pricing. If I remove the treasuries equation of how they manage interest rate risk, then from a pricing point of view, treasury prices at the fund transfer pricing for me, right? And treasury's job is to manage interest rate risk, not my job. My job is to manage the business and profitability based on the FTP, and that is why they're doing the transfer pricing. So of course there is going to be a impact on cost of funding going up a little bit, and definitely, and all your deposit durations are lower, your loan durations are longer, so you're going to see some margin pressure at the speed at which policy rates change, and how well the long-term rates, your bond yields also change. It's interesting. It's going to be interesting to watch. Definitely there will be some pass on, but then on retail side, it is so commoditized. You need to find efficiencies as a smaller player, because you need to play with the bigger players out there. So there's going to be pressure on funding cost, and that's going to translate in pressure on lending. So it's going to be, how do you optimize your capital is going to be the biggest conversation, I think, at least for this next 6 to 9 months in our ALCOs.
Prashant, I see you nodding. I think, and you've obviously worked with a bunch of different organizations and a bunch of different through different business cycles. So, any thoughts to add with
Yeah,
this?
maybe to pick up on something Jeff said, we see the need for, and this is not a plug for any particular sort of technology, but or platform, but just make sure that you have your ducks in order to be able to do good data-driven scenario analysis, right? You can't just sort of make this up. You need to have a view into, you don't know exactly how the future is going to play out. So understanding on, let's say on the deposit side, I know there's a lending webinar where those sort of flow of funds are and how things are going to flow, being able to predict them is going to be important. On the lending side, having almost a scenario-based playbook. So one of the best practices we see customers following is having a series of scenarios built out and having a playbook, right, that they can execute. Maybe the third thing to add is agility, right? One of the things we see customers get caught up on is you can get to a decision, but then your ability to move and get pricing into market is often sort of bottlenecked by lots of operational hurdles, and making sure that you're getting ahead of that, right, and that you're prepared to execute. So great planning, which is data-driven, analytically sound, and then just great efficient execution. Both of those things will be critically important.
Great, thanks. And Sadaqa, maybe we'll just close off this section with you to say, you mentioned 11 or 14 variables, right? So in those 11 or 14, do you guys contemplate, what happens in different scenarios? So again, benign PCL, rising rate, rising unemployment, whatever it is, right? So how does that tie into maybe the 11 or 14 variables that you talked about earlier?
Yeah, it's a good point. So all macroeconomic indicators, such as rising interest rate, inflation, Bank of Canada anticipation, that kind of stuff, that's all reflected in the Government of Canada cost of funds going forward, which is variable number one. And then we build on that, right? So if that goes up, then everything goes up because it just is cascaded going forward. Now, the Government of Canada have been very generous through the COVID period, and there was a lot of stimulus. And then now, as we're recovering, we're seeing a little bit of an inflation coming in. So there is a possibility that the Bank of Canada might increase interest rate to combat inflation. But that's not, forecasting interest rate and inflation. That's also another beast on its own, and that's beyond our capacity. What we do and what we suggest for our client is always kind of like match, just get the duration very similar, or pretty much get into a lock-in or a hedge or something like that, either a synthetic hedge or a natural hedge. That sometimes help. But what we've seen also from an industry perspective, we've seen a shift in the industry structure from a rate-based pricing into a fee-based pricing. So rather than charging someone 10%, we're seeing new founders are coming now, reducing the rate to 5%, but they're actually embedding a lot of sneaky fee structure. So you know what I mean? So that's pretty much the genesis for the a buy now, pay later industry, for example. There's no fees. So it's all about fees, but there's no rates, right? The last thing I would probably include is with digitalization, we're seeing a tremendous reduction in the cost of origination, customer acquisition, and servicing. We're seeing a lot of online banks that are fintechs that are managed to really break and make a lot of headways there. So that probably pretty much for the end consumer, I would say probably we're going to end up with a balanced situation. As rate goes up, yes, cost will go up, but as the cost of servicing and origination going down, the consumer will be almost indifferent at that stage.
So actually, that's something you mentioned in your answer was actually a pretty good segue when you mentioned buy now, pay later, right? And so if we start to move out of kind of the things happening in the industry to the things that might come down the pipe, right? We see that with BNPL, there seems to be a move for more convenience-driven lending, right? So that's a trend. Credit cards also getting into the split payment game. So if you're a loan shop, all of a sudden you have kind of this convergence, right? Maybe I'll ask Jeff, because you have to probably deal with the cards guys and the as much as the loan people and the HELOC people, right, where you sit. Can you talk about maybe what you're seeing in terms of buy now, pay later, credit card, like just some general thoughts or on what's going on from a lending perspective and the changing form function of credit?
Yeah, I love this topic actually. I mean, so in the way I think about it is a little bit like a spectrum, right? So you've got your more transactional based lending products versus your true kind of longer term lending based lending products. And so, on one side on the transactional spectrum, you've kind of got like overdraft, credit cards, and then as you move more towards longer term lending, you've got low rate credit cards, and then certainly then into low like core personal lending, and then over into kind of the mortgage space. And essentially, what these solutions are doing through buy now pay later and also the conversion of the credit cards, it's starting to blend the credit card space and the personal lending space in a way that we haven't really seen before. And I think it's really interesting. I don't have like a particular answer for you, but a few things to like think about as this is starting to happen. One, I think there's a cannibalization that you have to be very cautious about between the portfolios, and where do you see how do you make sure that you don't destroy the profitability or even have internal competition over balances or anything of that nature. So I think that's one thing to watch out for. Two is more about the cohesiveness of the offering. So how do you make sure that the pricing that's done on one side and on the other side actually makes sense when you as a single consumer actually are now just dealing with, in our case, one bank, right? And then three, more from a capability standpoint, and I swear I didn't mean to get 3 C's on purpose, it's just happened that way. But from a capability standpoint, how do we make sure that we actually don't build up risk-based pricing capabilities in multiple places? Like these are, to do it well, I think is actually a specialized discipline. And so I think we need to be a bit cautious about, as different products and different solutions are entering the market and the banks and the big banks in particular participate in multiple ways, and any other smaller players that are participating in multiple ways. How do you make sure that you don't duplicate the core talent and the capabilities and everything that you would need to make that be successful? So that's kind of my point of view on that evolution.
So Sadaqa, anything that you see from where you're sitting consulting on across different organizations around, buy now, pay later and kind of the whole cards and that convergence, anything that you see that, the folks might want to hear about?
There seems to be, the buy now, pay later industry is definitely growing at a double-digit rate. That wasn't the case, and that pretty much was fueled by the pandemic. One of the issues is we're having issues with benchmarking and data. So because it's relatively a new industry, there's a lot of error margin into it. Even if we have that model with 14 variables, the models cannot produce reliable data without reliable result without reliable data, and just the lack of data, it's critical. And there is some relative comfort when it comes to data relating credit risk, but there is almost no data available regarding what would be a reasonable cost of origination, reasonable cost of customer acquisition, reasonable overhead allocation, reasonable servicing costs, that kind of stuff. And then, also you gotta know that most of these institutions are relatively new, and that's not something that the big banks do. So we're also seeing lack of expertise and know-how within these organizations, just general funding requirements. So if, let's say, most of these institutions are funded by a warehouse facility provided by large insurance companies in Canada or banks, perhaps, I don't know if BMO does that, but in that regard, these institutions will remain super conservative, and they might be penalizing the buy now, pay later. So meaning that the terms are not favorable for the smaller lenders. So that is another challenge, but just the case with any things. I think we'll conclude by the biggest challenge for any buy now, pay later organization is a small ticket size. Because like with $300, $500, there isn't much, because when you're originating, let's say now the average price of houses in Toronto is over, I don't know, 700,000 million, something like that. Depends where you are. It could be more. But if you're, I see a lot of smiles. But I probably old. But the point is, if you're gonna spread origination cost and servicing over $1 million ticket, is completely different than splitting it over $300 ticket. So that's the biggest challenge, is a small ticket size.
Right. And Prashant, I know from a Noma's perspective, I worked with you guys back in my previous life. From a credit cards perspective, you've done some work on the loans perspective. From an overall price optimization perspective, any thoughts on kind of this cross product? Like, do you price by product, or is there a way to price differently so that you're helping to mitigate against kind of this convergence and confusion?
Yeah, and I really like something that Jeff said, right, which is to have a coherent and sort of cohesive view. Again, goes back to being customer centric, right? That's sort of the theme. And I think maybe the smaller institutions have an easier time with this than maybe some of the larger ones, where they may be a little more siloed in their approaches and how they're organizationally set up. So I think you got to get the organizational incentives, the organizational design, and the product design right, because ultimately you have a borrower, a customer who's coming in for a need, right? They're not thinking about your products, they're thinking about some fundamental need that they're trying to service. And so getting that design right is important. And then from a pricing standpoint, again, back to being data-driven, analytically informed, there are now, right, very robust tools to be able to look at that sort of cross-price view of the world, right, and the cross-product view of the world. So you're not just trying to price one product in isolation. I think that is important. On BNPL itself, fascinating sort of space. There are lots of questions about sustainability in the long run, right? Is it really good for consumers in the long run? Is it just just a masquerade of existing sort of credit facilities, right? There's lots of interesting debates, and is it sustainable, right, for the players? Clearly, I think I saw somewhere that Klarna has a market cap greater than Barclays. So clearly the investors have liked it thus far. So I think from a pricing standpoint, BNPL gets quite interesting because there is two-sided marketplace and lots of options, right, between the merchant servicing fees, between kind of how you trade off rates and fees. But ultimately, I think the consumer and the borrower needs to realize that they are still paying for it somehow, right? Regardless of the vehicle that is used, that they're being charged. So I think there are lots of sort of fascinating problems on just the BNPL product and the offering from a pricing standpoint to think about kind of consumer preferences and the dynamics that they can bring to bear. But again, back to taking that sort of holistic view of the customer need and making sure that you're not cannibalizing as a lender, as a bank, as an institution, not cannibalizing your own portfolio inappropriately, I think is going to be key.
Right. And then you mentioned there are a lot of new methods, right? And when we talk about, new methods and particularly from a pricing perspective, I think Jeff, you mentioned, again, the specific nature of pricing alone probably allows people to geek out a bit, particularly if you're optimization quantitatively driven. Maybe Sundar, I'll ask you, in terms of the way that you guys approach it, AI, ML, price optimization, can you talk about maybe how you've utilized those types of tools within your shop?
Yeah, definitely, especially on the this is a loan stuff, but definitely heavy on the deposit side, because that drives for us. Deposits is the most significant source of funding for us. So we use AI, machine learning especially on the price elasticity side, and how that will impact the flow of funds between products and how that will optimize pricing. That is pretty heavy investment, especially because we are moving into a federal journey where we need to be adequately, be adequate with respect to liquidity and capital. On the lending side, not much at this point in time. We are on the deposit side, we have partnered with our external agencies, as well as we have proprietary models. On the lending side, that is definitely something which we are looking at, especially where we have scale, right, on the retail side and the business banking side. commercial is like very unique, and you need mass to do any kind of modeling out there. It's tough for our scale, but definitely on the small businesses and retail, that's where our investment is. It's one of the top 5 priorities for us in this next couple of years as we try to go federal and grow our business.
Got it. Jeff, maybe this is a loaded question since you started kind of AI, ML over on the BMO side. So that's part of your claim to fame. But how do you find the banks, kind of larger institutions, taking to this type of approach? Like you probably have old school heads there or old school hats, right, in terms of pricing and risk-based pricing. And how do you find kind of the introduction of new methodology?
I actually would characterize it as very open in that regard, especially in something like pricing it's not as heavily regulated as something like credit risk, right? And so I think going outside of credit strategy certainly makes it a little bit easier. Going into pricing, I think we're just starting to dabble, to be honest. Like I'm not going to say we're super sophisticated, but I think we have an understanding of where we want to go. I mentioned optimization at the beginning. How do we get a bit more sophisticated, review the models that we've got, understand customer price sensitivity in this very not transparent market. And I think those are all great spaces to play for something like machine learning or advanced analytics in general. That's its bread and butter. So I think that is a priority for us as we continue to build out the sophistication of our engine.
Got it. And Prashant, that's, this is Nomus's bread and butter, right? So do you find that same level of openness and innovation across kind of different markets or across different size organizations?
We do, and I think it's certainly sort of accelerating quite rapidly, right? Again, and taking an outside in or a business problem results-oriented view always helps. You can always get fascinated by ML or AI, but sort of making sure that you're applying it and you're delivering results. I think that's a great motivator, right? And so we see it. Jeff and Sundar, I think you touched on sort of one of the core areas, understanding consumer behavior, price elasticity, sort of the willingness to pay pieces of it. So that's core. That's sort of critical and a core part of what Nomus does. The other 2 areas that are interesting and now rapidly emerging is how do you, especially in digital lending, how do you do, if you have the right scale, how do you do what Amazon does, right? How do you test and learn? How do you not just sort of simple A/B testing? How do you go to more sophisticated methods and actually discover things? Because your data alone, and especially historical trends, may not be telling you right what you need to know. So how do you apply multi-AMP banded techniques, right? Reinforcement learning. So there are lots of great approaches that are emerging now that we are starting to sort of tinker with. And the third, again, back to the human element, there are, again, lots of folks on the front line who can benefit from better tools, better guidance, better sort of enablers as they dialogue with customers. So digital lending, all the rage, but again, lots of hundreds and thousands of bankers and advisors out there. So that's the third area that we are, as Nomus, investing quite heavily, which is how do you take the data and apply an ML/AI and apply that, right, to provide better guidance and coaching to the advisors who can then hopefully help your customers and prospects better.
That's great. And I think, you mentioned human aspect, the customer aspect, and being customer centric, right? And focused on that. And maybe one of the things I'll ask, Jeff first, maybe. So as we've seen with all the deleveraging and kind of all of the social changes going on and has gone on with COVID, right? There is this, do you think that with all this change, do you think that the consumer or the borrower at the end of the day has changed? Is there a deleveraging? Is there a change in terms of the view of debt? What are your thoughts from a changing consumer perspective?
A couple of thoughts. One, I do think, and for those following, finance through the recession, probably have heard of K-shaped recovery. I think that holds true. Actually, I think that it's a kind of a tale of 2 stories. Although loan losses are kind of at an all-time low, I do think that there's still groups of people who thrived and grew, and groups that didn't have that same opportunity. So I think there's definitely some, I think, hidden stress still under the surface. So I think the deleveraging is not necessarily evenly split. Let me put it that way. Another kind of market trend that we're seeing is I think all the home prices have gone up, right? For anyone who's tried to buy a home in anywhere in Canada, really. And so I think what that does is it creates a lot of equity value in homes. And so I think what we're gonna see is people unlocking that equity to make their purchases, to find lower rate financing, especially the ones that are a little bit more financially savvy or getting the right advice. And then the ones that would lean towards kind of higher rate loans are probably ones that don't have access to that. So how that exactly is going to shake out, I don't know, but I do think that that equity for people who owned their homes prior to the increases over the last couple of several years, they're sitting on a ton of capital, and they would probably tap that first.
Got it. Sadaqa, maybe I'll go to you. Anything that you're seeing from a consumer perspective, or any views on how the consumer might have changed? Oh yeah, no, go ahead, Jeff.
I'm so sorry. I actually wanted to build on one point, which is I think that's all largely thinking about larger kind of loan purchases. I wanted to loop it back actually to buy now, pay later, which is also the convenience play, right? Which is, if people are going to go into the home equity, let's say in the case where they actually have something big they want to finance, but there's something to be said about the convenience at transaction in your face. Hey, you're buying that treadmill online, and they pop up and say, hey, you could finance this for $20. I think that's going to also be a player in that space. So I think it all is going to come together to shake out really a kind of a different environment going forward.
Thanks, Jeff. Sadaqa, what do you think around the consumer and how the consumer might be changing?
What's happening is that most of the change is not from the consumer side. Most of it's change on the lending side, in a sense that there seems to be a boom of easy credit available to more wider spectrum of society. And it's really a catch-22 because there are certain, traditionally in the past, and we had this prior to 2007, 2006, and 2008, and that what led into the issues that we got into these ninja loans, right? No income, no asset, no verification, and just giving money left and right, right? Now we're hitting this not again with the mortgages, because we've learned this and the regulation is quite tough, but we're probably hitting this with the small ticket items, meaning that there is a boom in fintechs and smaller lenders, and they're getting, they desperately want to please their investors. So they are under a severe pressure of jacking up their origination numbers and being a little bit easy on the credit criterias. And then in addition to that, it's quite difficult to manage a company when you have average asset class of about $500-300, not like we have, Austrians on top of you and dealing with a regulated industry. So the question is, how is the non-regulated lending institutions behaving in Canada, and how much of the share of the pie has that increased relative to the traditional model? So, because I see a lot of easy credit from the non-regulated, non-bank lenders. Yeah, Paul, are you there? Sorry.
Paul's frozen.
Looks frozen.
I think Paul's frozen. We'll give him a minute to come back in. There's a question in the Q&A that maybe we can jump to. Well, I'll read it out. We have a question here saying, any option on penalty pricing? Oh, Paul's joining back in. Perfect timing.
Hey guys, sorry about that. My Wi-Fi just died. But fortunately, we only have about 10 minutes left, and I think maybe maybe what we'll do is I might point it to Prashant maybe to close us off in terms of the section, and then we can go to the questions that are on our Q&A board. So Prashant, anything you're seeing around as you're working with different customers around deleveraging or kind of, again, the changing nature of the consumer and how you price for that?
I don't know if I think it'll become a pricing question. I think there's a bigger question we haven't seen great answers yet on product and offering design, right? And I think Jeff made the point about the K-shaped recovery. There is clearly a segment of the market that can benefit from some creative thinking here from the institutions on products and offerings that can actually benefit them. So I think that's almost a question back to our customers and partners to say, how do we innovate, right, in terms of the product offering and the design that can actually better service the leg of the K that hasn't done very well. So that's what I have to offer. I think pricing then will follow. But thinking about kind of the product structure and the offering design is going to be key.
That's great. I think that, that's probably a great way to end off kind of the discussion that we've had so far. I think throughout the call we've talked a lot about being consumer centric, having very much of, like you mentioned, having the product front and center, and then understanding the economics and kind of the nuts and bolts of how you actually get to profitability. And obviously there's a lot of different methodology that we've touched on today that would help organizations to really maximize that yield and better manage their book to profit. So why don't we do this now? I know that there was a question on the board around penalty pricing. So maybe, I don't know, I'll open it up to the team around, or to the panelists around, from a penalty pricing perspective, any thoughts on that? Any methodology or any approach that people might have seen? I know it's probably more on the card side, right? But from maybe a loan perspective or line of credit perspective, things like that. Any points of view on penalty pricing and how you might lather that into a strategy that you have?
I can start that one. Oh, sorry. Did you want to go ahead, Sundar?
Go ahead, Greg. Interesting. Go ahead.
Okay. So I think penalty pricing is it's a really interesting topic. So you're right. It's primarily in credit cards today, but I think there is room to do more, right? So on the surface, it might sound, I think the question says, does that help anyone? So on the surface, I think it might sound bad, right? Where people might be struggling and you're pricing them up, and does that force them to go to deteriorate further? On the other side of it, you could say, if you put it into a full strategy, which says actually those people have now direct indication of higher risk, and now they're essentially compensating for it. And now, can I actually price that segment down otherwise for the rest of the people that haven't exhibited that behavior? And so I think there is a creative way you could align risk and reward in that way, while at the same time kind of coupling it with a broader strategy, so that overall it actually creates better situations for a broader amount of people. So I think that's one way of thinking about it that actually I'm trying to think through as well in our own personal lending space.
That's great. I think somebody else wanted to say something.
That's fine, Paul. Jeff covered it. Only thing is, it's a good opportunity to learn from other line of businesses. I would not say penalty, but there is, you take a line of credit, for example, if it is not utilized, especially with current consumer behavior, then you're looking at holding capital for no reason. There are a lot of, instead of calling it a penalty, there is of course a convenience fee when it comes to the small business loans and line of credits to the small businesses. Is there an opportunity to transfer to retail? I doubt it. Only if the bigger players do it, we can. But definitely there's some opportunity there to start pricing, provided the kind of value you provide, and line of credit is one area I think there is opportunity.
I would like to add is, like, okay, so if we're gonna charge penalty, what's the reason behind that? And so maybe there's some damage or cost incurred from the lender side, right? That might particularly hit two criterias. One, I would say, has to do with prepayment of the loan, because banks incur significant cost in origination and customer acquisition, and they anticipate to spread that over the duration of the loan. So hypothetically, if the duration of the loan is 4 years and the customer prepays a loan in the first 6 months, so there's not enough time window to spread off the cost on that. So the banks will have to eat up, or they will be in a loss position. So that's why a lot of the banks or lending institutions, they charge a prepayment penalty from that perspective. There is a second penalty structure, might be around late payment fees to offset the cost of credit risk and delinquencies. That sometimes is done, but eventually I'm not a big fan of that, because you're charging people who can't actually pay, and that just push them more into trouble. But the first one, the prepayment to offset customer acquisition costs, is more reasonable. These are the things that I would probably go with.
Got it. And Prashant, I see you've taken yourself off mute. Anything to add from a penalty pricing perspective, or are there strategies that you've seen employed or that Nomis has helped employ from a penalty pricing or a differentiated pricing perspective?
Yeah, I don't know if maybe not differentiated as much as sort of creating transparency around it helps, right? So borrowers are aware, or customers are aware of what they're signing up for, and sometimes, right, that is not as transparent, or at least not as simply transparent as it could be. So I think there is that aspect of it, and I think Jeff touched on, hey, if you could get the right separation, in some sense, there's some adverse selection signaling going on. Could you then price the other segments better, right? So that's a benefit for the broader portfolio. And there's always the carrot and stick, sort of, where do you create an incentive for somebody to take an action versus the disincentive to not take one. So
great. And I know that we've got about 2 minutes left, so maybe I'll just use this to wrap us up. So first off, thanks to the panel, right? Who knew that loan pricing could be so exciting and interesting? This was definitely, a great way to spend a Thursday afternoon. And, I thank you all for your time and for the thought and preparation that went into the session. And, maybe I'll thank the attendees as well, right? So again, very happy that everybody got to join. And this was a blast. And thanks to the CLA for organizing. And maybe with that, Danielle, I'll pass it back to you maybe to close us off.
Yeah. Thank you all so much for joining today. And again, thanks to our panelists, and thank you so much to Paul for an amazing session. And with that, I'll close things out.